Let's talk about saving and investing money. Before you start investing money, you need to build an emergency fund, which is sometimes called a rainy day fund. This fund will contain 3 to 6 months of salary, so if you lose your job, it will help you pay your bills while you look for a new job. These days, some people recommend saving 6 to 12 months of salary because the duration between jobs has increased. The rainy day fund is for emergencies only, not day-to-day expenses. It should be saved in an accessible liquid form, such as a bank savings account, where you can tap into the money in a hurry should you need it. Only after you've built a rainy day fund should you start thinking about investing your money. But if you have any debt, such as student loans, it may be best to accelerate repayment of that debt before investing the money. If you have a debt that doesn't have a prepayment penalty, you can make extra payments on it. Now, if you're paying 15% interest on your credit card balance, paying off that balance is like earning a 15% return on your investment tax-free. Oftentimes, if you will get a better equivalent return on your investment by paying down debt than by investing the money, since the interest rates on loans are often higher than the interest rates on savings. The main exception to this rule is saving for retirement. Some employers will match your contributions to your 401k plan, which is a specialized savings plan for retirement. You should save enough to maximize the employer match, since that's free money. After you've paid off your debt, you can start investing the money in other savings plans, such as saving to buy a car, for a down payment on a house, or in a college savings plan. It's always better to buy something from savings than to borrow the money. To make it easier to save, try to make the savings automatic. Most banks and brokerages will let you set up an automatic monthly transfer from your bank account to a savings account or a brokerage account for free. Effectively, the brokerage account will be paying the electronic funds transfer fees. Take it one step at a time. Break down your savings goal into monthly amounts. If you focus on the target amount, you may throw up your hands and say, I can't do that. But if you break it down into small monthly amounts, it gets much easier. It is more important to get started, though, than to save a particular amount. Even that monthly amount may seem too big. So save what you can, as opposed to what you need to. After you've set up the automatic monthly transfer, you're going to get quickly used to not having the money to spend. And then you'll be able to start increasing the amount you save each month. Whenever you get a raise, increase the amount you save. Also save half of any windfall you get, such as a bonus, tax refund, an inheritance. That way you're getting some gratification by having some money to spend on yourself, but also spending some money by saving it, so you're paying yourself first. When you're saving from retirement, ideally you should be saving a fifth of your salary for the last fifth of your life. You want to live below your means so that you will have the means to live when you retire. Unfortunately, most people on average save about 7 or 8% of their salaries for their retirement. They should be saving more. Bank certificates of deposit are the safest investment because they are FDIC insured and there is no risk of loss to the investment. Whereas with a stock, the stock price can go up, it could go down, and you could lose money. But bank certificates of deposit have some of the lowest rates of return. So with the low risk comes a low rate of return. To get a higher rate of return, you will have to take on more risk. And that can involve investing in the stock market. When you invest in the stock market, start by investing in a broad-based index fund, like an S&P 500 fund or a total stock market fund. An S&P 500 fund is an index of the 500 of the stocks of the 500 largest companies. These funds mimic the performance of the stock market as a whole, so you won't lose as much money if you happen to invest your money in one bad stock. It diversifies your investment, so each individual stock has a relatively small impact on your overall investment. It's a way of not putting all of your eggs in the same basket. Most people, over the long term, are unable to beat the performance of the stock market as a whole. Even professional money managers generally don't beat their indexes that they're trying to match. So why not invest in such an index fund? Because if you're not going to beat it, you might as well just invest in that index fund. When choosing an index fund, consider the fund's expense ratio. This is the fees that are taken off of your returns to pay the company that's managing the fund. The best index funds will not only perform close to their underlying index, but will also have a very low expense ratio and will be managed to minimize the tax impact of the investment.